Hi, I'm Wes Burke with Central Coast Lending. Thanks for joining me for today's mortgage market update. I'll jump right in, but be sure and stick around. I have a special free offer at the end.
Today is Monday, April 27th. Let's get into what's actually driving mortgage rates right now and what you should be doing about it this week. From a market standpoint, this is becoming a classic push-pull environment between geopolitics and the bond market. Last week, we saw the 10-year Treasury continue to trade in a fairly defined range, roughly 4.2% to 4.4%, and that's been the anchor for mortgage pricing. Mortgage-backed securities have been following that same pattern, not breaking out, but definitely not improving meaningfully either. And here's the key: MBS spreads are still elevated. That means even when treasuries improve, mortgage rates aren't improving as much as you'd expect. There's still caution in the secondary market. Investors are demanding extra yield to hold mortgage paper given volatility, prepayment uncertainty, and headline risk. So from a Chrisman-style lens, the story isn't just where are treasuries, it's where are MBS trading relative to treasuries. And right now, that answer is still a bit defensive. The dominant driver continues to be the Iran conflict and oil volatility. Every time we get escalation headlines, oil pushes higher, inflation expectations tick up, bonds sell off, and mortgage rates worsen. When we get de-escalation or stability headlines, we see the opposite. Oil pulls back, bonds rally, and rates improve slightly. But here's the nuance: those improvements have been short-lived. That's why you're seeing rate sheets improve a little, then give it right back. The market doesn't trust any single move yet. At the same time, economic data hasn't forced a breakout either direction. Inflation is still sticky in pockets, but not accelerating across the board. So we're stuck in this range-bound, headline-driven market. Now, what does this mean for you as a loan officer? First, this is not a wait for better rates environment. This is a capture opportunities inside the range environment. Rates are moving enough to create urgency, but not enough to justify sitting on the sidelines. And that's exactly how you need to frame it with your clients. You're not promising lower rates. You're showing them how to win with today's numbers. Second, this is where rate sheet awareness becomes a competitive advantage. If you're watching pricing daily and even intraday, you can move faster than your competition when pricing improves. There are real windows right now: a small MBS rally, a better morning rate sheet, or a lender repricing for the better. That's when deals get done. So practically, this week, be checking pricing multiple times a day, lock decisively when you get an improvement, and communicate urgency to clients, because those windows are closing just as fast as they open. Third, your product and structure are everything right now. With spreads still elevated, borrowers feel rates more. That means temporary buydowns are incredibly powerful, and FHA and VA execution is critical. And even ARM conversations are becoming more relevant again. The LO who knows how to structure a deal in this environment is the one who gets the contract. Fourth, this is a realtor conversion market. Inventory is improving, price reductions are happening, but buyers are hesitant. That creates a gap, and that gap is where you step in. Your conversation with agents this week should be simple. I can help you convert more of your buyers in this rate environment. Not with fluff, but with payment strategy, creative structuring, and speed. That's what agents need right now. Bottom line, we are in a market where treasuries are range-bound and MBS are trading defensively. And headlines, especially around oil and geopolitics, are driving short-term rate movement. That means one thing: execution beats prediction. The loan officers who win right now are the ones who stay active, move quickly, and turn market volatility into opportunity. If you're looking for a better way to operate in a market like this, with stronger tools, better systems, and real support to grow your business, reach out to me. I'd love to show you what we're building at Central Coast Lending and how it can help you take your production to the next level.
Thanks again for joining me today. As I mentioned in the beginning, I've got an offer for you. At Central Coast Lending, we've been using a very robust CRM called Go High Level for our loan officers, which is empowering them to manage all of their social media marketing, all of their outbound marketing, and basically just do a much better job staying in touch with their database and providing relevant market-related content. For the first 10 of you that respond, I'm willing to set up a free iteration of this CRM for you. This is the same CRM that's being used by organizations like Mortgage Marketing Animals, and typically this CRM costs between $300 and $500 a month. If you'd like to learn more about this, simply reach out to me. My contact information is on the screen.